Welcome back! In this second presentation on stocks, we'll discuss securities marketplaces. In other words, where do you buy and sell these things? And then we'll start to dig into the different indices and how we measure how well the stock market's doing as a whole, and then we'll start looking at individual stocks and numerical measures for individual stocks. And we hope to show you that it's really not as hard as people make it out to be. As Warren Buffett says, investing is simple, but it ain't easy. And we've already discussed that, right? The intellectual part is relatively straightforward. What's difficult is the emotional part and predicting the future, because nobody can predict the future accurately. It's easy to predict the future inaccurately, and a lot of people do it, and get paid pretty well, and maybe you can be one of them. Anyway, let's start on slide number 19. What are securities marketplaces? What a silly name. It's just where are these things traded. That's what it means. Securities is just, it's a fancy term that means financial assets that can be traded between investors. And the marketplace, the securities exchange, is where this happens. And for decades, for almost 200 years, over 200 years, the place to be was the New York Stock Exchange, the big board. But you know what? It's now owned by a derivatives trading firm in Atlanta. And what are derivatives? Don't even bother with them. They're just scary ways to lose a lot of money quickly. Yeah, and then the American Exchange, it used to be called the Curb. Why? Because it started out on the curb outside the New York Stock Exchange. Well, they got their own building, thankfully, because it's cold in the wintertime out on the streets. But then they got purchased by the NASDAQ, which then gave them up. And then they got purchased by the New York Stock Exchange, and they changed the name to the New York Stock Exchange MKT. I'm sorry, MKT Market, I guess it's supposed to be MKT. Anyway, but what happened? They were never very big, right? The American Exchange, they were the little kid down the street. But the NASDAQ, the National Association of Securities Dealers Automated Quotation System, which they don't want you to remember, that's what it originally meant for. They just wanted to be called the NASDAQ. They got big, yeah, and that's where the technology stocks like Microsoft and Apple and Intel, that's where they live. And so now it's a two-horse race, the New York Stock Exchange and the NASDAQ. The over-the-counter markets, folks, stay away from these places. If anybody tries to get you to buy a stock, a penny stock, on the bulletin boards or the pink sheets, just stay away. That's the wrong side of town. The red light district, the wrong side of the tracks. It's just the wrong place to be. And so let's read. For hundreds of years, these marketplaces, and for the New York Stock Exchange and the New York Stock Exchange MKT, American Exchange, they were centralized locations. But that's the old technology. With today's technology, the vast majority of transactions occur electronically. No one's yelling and screaming at one another anymore. There's a little bit of that. There's a few transactions that still occur there, but really, I think they just keep it around for show. I really do. So they have something to show on the television at night. So when you go online and buy and sell stocks, or your broker does it for you, or your mutual fund does it for you, it's all happening electronically now. Yeah. Slide number 20. To gauge the current condition of stocks in general, financial professionals have created various stock market indices. It's just a list of stocks, folks. That's all it is. We call them stock market indexes, indices, averages. And by far the most popular, even though it's not a very good one, is the Dow Jones Industrial Average. The Dow. Yeah, it's the granddaddy of them all. Started in 1896. But the problem with it is it's only 30 companies. Now, these are some of the largest and best-known companies, but still, it's only 30 companies. So it has a tendency to not reflect very well the overall market conditions, although people look at it for the market. And what we would do in the face-to-face class now is jump to this handout that I give to say, hey, I'm going to give you $10,000, 80-some years ago, okay? A long time ago. And which company would you pick, okay? So, you can do that on your own. It's in Canvas, and it's also on the website. So do that one on your own. But don't peek, all right? Choose one company and listen to the commentary, and then, well, how'd you do? The better measure, but the one you don't hear as much of, if you follow the stock market, you're going to hear about it, but the one that they often don't talk about on the news is the Standard & Poor's 500. That traditionally is a list of the 500 largest companies in the United States. Now, a few of them are foreign because some foreign companies have purchased very large United States companies, but they're mostly United States companies. They're big companies. And this one's a better gauge. Although it's not perfect either, because nothing is. And we discussed the imperfections in the Business 123 Introduction to Investments class. The NASDAQ. Remember we talked about the NASDAQ? Well, the NASDAQ Composite Index is a list of stocks that's on the NASDAQ. And most of them are high-tech companies. Not all. Costco is on the NASDAQ, Starbucks. So not all the companies are high-tech companies. But when we want to see how the technology part of the economy is doing, and the companies that make up that technology part, we often point to the NASDAQ. So these are the big three, and you'll often hear, they always talk about the Dow. I don't know why, because it's not that good. But they'll also include the NASDAQ, and sometimes they'll have all three, the Standard & Poor's, the Dow, and the NASDAQ. Now, there are others, though, that are going to become more important to us in the next chapter, because the world is not just the S&P 500. And on slide 21, we see a few of the others that are important, but you don't hear too much about them until you get involved in the industry or you start investing. And the first one, which I hate the name, they used to call it the Wilshire 5000. Now they've called it the Dow. The Dow Jones somehow made a deal with Dow Jones, by the way, they're the folks that published the Wall Street Journal, but they're now owned by Fox News, so figure that one out. Dow Jones U.S. Total Stock Market Index. Huh? Well, it started out as the Wilshire 5000. That's what it was called, but that's not what it's called anymore. And it varies up and down. At one time it was 7,000 stocks. Now it's down to about 4,000. But the idea is we want to get the large companies, that's the S&P 500, and the medium-sized and the small companies. So you'll sometimes hear people call this the entire stock market or the total stock market. Yeah, the big companies, medium-sized, and the large companies. And we'll discuss that later on. What's the Russell 2000? Well, this is meant to represent just the small and the medium-sized companies, huh? What do? They take the top 3,000 companies by size, and they lop off the top 1,000. So how are companies in the small and medium-sized world doing? And then, all we've been discussing is the United States. What about outside the United States? Well, many years ago, a company called Capital Group, Capital International, the division of Capital. Hey, you've never heard of them, but they're very big, and they're actually a very good company. They started investing outside the United States, and they said, you know what? We want to have some kind of measurement for what's going on outside the United States. So they created the World Index. But then they were measuring themselves. Yeah, not a good idea. Definitely a conflict of interest. So they sold it to Morgan Stanley. So that's why MSCI stands for Morgan Stanley Capital International World Index. And that was the entire world, the United States and everybody else. But, many years ago, that was only a few parts of the world. Western Europe, Canada, South Africa, Australia, Japan, who else? Hong Kong, Singapore. And so instead of just changing it so that it would include, South America and Eastern Europe and China and India and the Philippines and Taiwan and Korea, they created a new index called the MSCI All Country World Index. Now, they didn't ask me. I mean, I would have told them, well, just change the world index so it's a world index. So people don't have to remember all country world index. I mean, it's a goofball. But, hey, that's their business, and they don't care about what I think. And the other one, the MSCI EAFE, and that's how it's pronounced, by the way, EAFE, stands for Europe, Australia, and the Far East. So in other words, how are companies doing outside the United States, right? And again, they never changed the EAFE. They just let, they had a Europe, Canada, Australia, South Africa, who else? Japan, Hong Kong, Australia, of course, Singapore. And they never changed it. They just kept it, and they created a new one called the MSCI All Country World X USA. How's he supposed to remember that? I mean, it's a dumb name, but hey, that's what it is. And so these you don't hear too much about, but they're important because we want to know how the world is doing. The small company stocks, all the stocks in the United States, how's the world doing, including the United States, and the world without the United States. And so I follow them, certainly, and most professionals do. Slide 22. Have you heard the terms bull market, bear market? Well, we won't get into the etymology of how that's the right word, right? Etymology of how these words were created. But bull markets mean everybody's happy. More investors buying stock market increases, the economy's doing well. Bear markets are when the market goes down and more investors are selling stocks, so the stocks decline. And this is normally defined as a 20% or more decline. If it falls 5, 10, 15%, that's just a correction. Whatever, it's going down. And for whatever reason, sometimes it's because people get spooked. They just get, there's an old, it's a bit of a joke because there's an old saying that there's three emotions that rule the markets: fear, greed, and greed. It's a joke because greed usually wins out. But sometimes fear wins out, so fear and greed. And sometimes people just get frightened and everybody heads for the exits. Yeah, well, other times it's a real reason. The economies are tanking for whatever reason, and people decide, you know what, I don't want to invest in stocks now. But those bear markets turn out to be the best times to invest, folks, historically, because when do you want to buy? Right, you want to buy high. You want to buy low. You want to sell high, you want to buy low. But again, emotions come into the game. And of course, if the market goes down and stays down and becomes basically worthless, then it doesn't really matter where your money is, because that means the whole economy has failed, and we'll all be digging for beetle grubs and eating bark for dinner, boiling bark for, let's not go there. Slide 23, stock analysis. Okay, where do we start, right? Well, Benjamin Graham was Warren Buffett's teacher, and he wrote a phenomenal book, The Intelligent Investor. Don't read it as your first book, okay, because it's pretty weighty. There's a few other books, One Up on Wall Street, A Random Walk Down Wall Street. Those are better to start with. But he said it very succinctly: show me the numbers. Just show me how it's doing. But there are dozens and dozens of numeric measures. And so we're only going to learn a few of them, folks. Some of the most popular over the years have been capitalization, book value, earnings per share, price-to-earnings ratio, and the dividend yield. So let's take a look at these. And as we go through this in the face-to-face class, we would, of course, be going to the worksheet, because there's a worksheet for Chapter 12, and it turns out that the calculations are a whole lot easier than the bond calculations. So you can follow along in the presentation and do them, pause the presentation, or just, do it afterwards. But do them, okay? Please do them. And what I hope you will find is you'll say, this isn't that hard. And the truth is it isn't. The understanding of the stocks and the measurements and the like, they're really not that hard. What is difficult is simply adding your judgment about which companies to buy, because the world is always changing, and it's very difficult. It's impossible to accurately predict the future, as we've said. If if we knew what was going to happen, we wouldn't call it the future, right? It's easy to look at the past and say, well, gee, I should have sold, I should have bought. But it's harder when you're looking into the fog of the future. Slide 24. Market capitalization is a very important number that people just don't even bother looking at. Everyone looks at the stock price. That's the wrong thing to do, folks. It's really not a smart thing to do just to look at the price. You have to look at the value of the company. And how do you get that? That's what the capitalization is. You take the number of shares multiplied times the current price of the stock. See, the current price of the stock is meaningless unless you know how many shares there are. That's what the company is actually worth. If you wanted to buy the company, if you wanted to buy the whole company, that's what you'd need. Actually, you need a little more because as soon as you started buying all the shares, the price would start going up, and that's the problem. But anyway, there are three major groups: the Papa Bears, the Mama Bears, and the Baby Bears. I don't know if that helps you use it. But large cap stocks are generally considered anything over 10 billion. Now you're hearing more and more people, this number changes over time as companies get larger. You're hearing more and more people say, nah, it's got to be at least 15 billion before it's a large cap stock. Well, you decide. You pick either one. If it's a 10 billion, 12 billion dollar stock and you say, well, it's large cap, I'll accept it. If you say it's mid cap, the medium-sized company, I'll accept that also. When you get above 100 billion, you get into the rarefied world of what are called mega cap stocks. It's a subset of large cap, so you don't have to remember it. If you do, great. If you don't worry about it. But these are big companies. The brand names that you've all heard of, and certainly the tech titans, as they're often called, like Apple and Microsoft and Facebook and Google and Netflix and Amazon. These are all mega cap stocks. But you don't have to remember that. Just remember large. Anything above 10 billion. Now, in our class, we'll do between 1 and 2 billion to 10 billion for the Mama Bears, the mid-cap stocks. And you've probably heard of some of them, but most of them you will not have heard of. Again, some people will say, no, it's got to be at least 4 or 5 billion, up to 15 billion to be mid-cap. And either one is up to you. You decide. I'll take either. And then when you get into the small cap stocks, most of these companies you've never heard of. Some of them you have, but most of them you've never heard of. And they're anywhere from, 100 million or so up to 1 or 2 billion. But again, people are saying, no, it has to be up to 3 or 4 billion before it's leaving small caps. Anything below about 100 million is considered micro cap. It's still a small cap stock. You decide if you want to remember that, but that's the subset, micro cap. And these companies, most of them you've never ever heard of, and you can make a lot of money off of these things, folks, but you can also lose everything because every big company at one time was small, right? Obviously, by definition, you got to start somewhere, but normally, no, folks. Many of them disappear. And you'll hear people say that small cap stocks have done better than large cap stocks over time. And they're right in one respect, and they're wrong in another respect. The problem is they often don't count the ones that just disappear. It's called survivorship bias. And so with survivorship bias, the ones who disappear don't get counted. And so that's why it looks like that small company stocks have done better. But the truth is, if you're a good stock picker and you pick small company stocks well, you're going to do well. But it's going to be very volatile. Now, penny stocks. These are companies we shouldn't even mention. We just shouldn't even mention them in polite company because, folks, this is the way to get poor quickly. Stay away from them. Those are the stocks that are on the bulletin boards and the pink sheets that we talked about. Just stay away. And they say anywhere from $1 to $5, but that's not necessarily true. Some of them are pennies, literally 5 cents or 7 cents. And sure, if it goes up to 12 cents, you're going to make a lot of money, but it's more likely to go down to 1 cent or a whole lot less. And we see some examples on the website and in Canvas. You'll see some examples of just There's thousands of them, folks, and they're all almost all scams. Yeah, almost all. Stay away. Slide 25. So here's an example. We have $50 price. Well, how much is the company worth? Well, we don't know until we know how many shares are out there. How many shares are out there and being traded? If you have 2 million shares, that's $50 times 2 million, or $100 million worth of market capitalization. This is a small cap stock. The stock price, for the most part, is irrelevant. You must look at the market cap to see what the value of the company is, and we'll see some examples later. Okay? So, if you wanted to own this stock, you'd have to have $100 million in your pocket and go down to the exchange and say, I want to buy this. Well, as we said, it doesn't really work that way. If one company wants to take over another company, or an individual wants to take over another company, they go to the exchange and they say, look, we're interested in buying this company. So we'll make what it's called a tender offer. I don't know why it's called that, but anyway, and so you have to come up. For example, if this stock we're selling for $50, you have to basically come up with 55 or 56 or a little bit more, anywhere from 10 to 20% more. And then what they do is they have a set methodology for announcing this. And then when they announce it, if investors believe it's a real offer, that this entity, this company or the individual person or group of people can actually come through with the goods, the price will snap right to that, or maybe a little bit below that, or maybe a little above that, that number. So you think there's some hanky-panky going on? Right. Somebody could just come along and say, yeah, I'll pay $55 a share. The price jumps to 55, and then it turns out that they were just blowing smoke, and the price falls back to 50. Yeah, there's a lot of shenanigans that go on down on Wall Street, folks. Nothing's perfect, and it reminds me of that famous bank robber who didn't really say what he was told, everyone says he says, but he was supposedly asked, why do you rob banks? I think his name was Willie Sutton, right? Or Willie Horton? I can't remember. Why do you rob banks? And supposedly said, that's where the money is. You know, he didn't really say it. But anyway, it's a cute story, right? Because this is where the money is. Slide 26, book value. Now, this is an interesting one because this should look familiar to many of you folks. This is the net worth of a company determined by deducting all the liabilities from the corporation's assets and then dividing the remainder by the number of outstanding shares of common stock. So in other words, remember our net worth statement? Assets minus liabilities equals net worth. Well, this is the same thing, but for a corporation. You take the assets, you subtract all the liabilities, and you have a number, and then you divide that by the number of shares, and that tells you how much each individual share is. And it's rarely close to the stock price, often 1/5 or 1/6 or less, right? Why? And it makes sense. It makes sense that it would be. Because if you're a company, the fact that you're in business and earning money means that your worth is more than just the assets on the books. That's what we call book value. If think of a pizza shop or a shoe shop. The pizza shop, what are they? Got pots and pans, and then they got some nice fixtures and all the furniture and the like, and the oven is the most expensive thing, right? But if they sold all those pieces, the company would not be worth what it's worth. The fact that it's earning money, the fact that it's a going concern, as the IRS uses the term. So this is true of companies, and we're going to see some examples. Now, every once in a while, the stock price is lower than the book value. It's very rare, but it happens. And when this happens, there's a real danger of the company being raided for the assets and put out of business. So you're working for a company that's been around for over 100 years, and things have changed, the technology has changed, and the company really hasn't kept up, and the price keeps getting lower and lower and lower. But this company has lots of assets. Well, once the price goes below the book value, assuming that the book value is a bona fide number, bona fide meaning real, it's not just on the books by the accountants, then these corporate raiders come in. You might have heard of them, corporate raiders, private equity takeover artists, private equity firms. and they will come in, buy 50% plus 1 shares. Which means they run the company now. They can vote anything into being, and they put the company out of business, sell all the assets, pay off all the debts, and then walk away. Now, how would you feel? You've worked there for 22 years, and now you're out of a job because they liquidated the company. You'd be pretty upset, wouldn't you? And you'd go to your politician and say, why are these people allowed to do what they're doing? This is outrageous. Why are they putting profits over people? And the economists and the takeover artists, if they deemed you worthy enough to speak to, which they probably don't because they've already left on their private jets, they would say, no, you don't understand capitalism. That company needed to be plowed under like a field by a farmer. That capital, which is a fancy word for resources, was not being utilized efficiently. It needed to go out of business. Great, now I'm out of a job. And that's why we have unemployment insurance, folks. We don't have unemployment insurance to pay people not to work. No, that's not what it's for. Now, do some people game the system and take advantage of it? Oh, sure, nothing's perfect. It just doesn't, it's in a perfect world, and there ain't no such thing. People would not do that, but some people do. But the idea is we want this to happen. We want that capital, including the people who are working there, to be better utilized toward furthering the success of our economy. I know it sounds like an advertisement. I apologize, but that's the idea. Now, is it perfect? Of course not. Nothing is. But that's the reason we promote that. We want that to happen. Slide 27. Earnings per share and price to earnings ratio. Now, these two are very important because we can use the earnings per share and think of our little stock, our 1 share of stock, as a little economic engine. How much is our 1 share of stock earning for us? Well, the calculation is fairly straightforward, and we're going to do 1 or 2, but you don't really have to. You just look it up on the Infernal Net. But corporations' after-tax earnings divided by the number of shares, and the idea in the world of investing is to look for growing earnings per share. It's a very dynamic system. We want growth, right? Yeah, well, sometimes companies are growing their earnings very quickly and the stock price becomes very volatile. And other companies that are not growing their earnings very quickly, the stock price is far less volatile, but it's not as exciting, right? That's growth is what people want. Then you take those earnings per share and you relate it back to the price. And this sounds funny, PE, price to earnings ratio, physical education. No, price to earnings ratio. And it's often written as P/E or just PE. This is the most watched market statistic, stock market as a whole and then individual stocks. You take the price of a share of stock and you divide it by the earnings. Usually over the last 12 months, but sometimes they do future earnings. Well, you don't know what the future is going to be, so they estimate it. And a low price to earnings ratio usually means the stock is a less risky investment, whereas a higher price to earnings ratio means that the stock is going to be a higher risk. Now, is it worth it? Yeah, that's the problem, and we'll see. We'll see in 3 to 5 years if it turns out that it was a good idea to go with the low-risky stock or the high-risky stock. And why would we want to own a business? Well, because businesses are in business to earn money. So let's take a look at this example. Here's a company that's earned $2,500,000. Now, is that a lot of money? Yeah, to you and me it is. But we don't know what it means for this corporation until we know how many shares are outstanding. So you take the $2.5 million and divide it by the 5 million shares, and you get 50 cents earnings per share, EPS. Which means that every single one of your shares, whether you own 10 or 1,000 or 10,000, everyone is earning 50 cents. Like a little engine. Does it make sense? Yeah. No pun intended, folks. And so EPS is 50 cents a share. Now, let's take this 50 cents per share that we just calculated on slide 29 and relate it back to the price. The price of the stock, let's say is $10, example. So you take $10 divided by the 50 cents and you get a PE of 20. Now, don't put a percent sign, don't put a dollar sign. It is unitless. There's no unit to it, but some people will throw a percent sign in. It doesn't belong. Is that high? Is that low? Well, let's take a look at slide 30. Historically, a high PE ratio, a PE ratio of 20 or above was considered high and reserved only for the fastest growing stocks. You see, the faster the stock is growing, the higher PE you'll see with the stock associated. Why? Because people are bidding up the price relative to the earnings because they're expecting the earnings to grow. And historically, 5 to 15 was considered average. But at different times of our history, and now, for example, PEs of 30, 40, 50 were not uncommon. And I'll never forget looking down in the height of the internet bubble in the late 90s at the computer and seeing PE for eBay at 10,000. And I said to myself, this ain't going to continue. No way, right? And when the market falls, right, PE ratios fall dramatically. When the market rises, PE ratios rise. The price to earnings ratio essentially tells you what the market believes the prospects for a company are. It doesn't mean they're right. Often they are, not all the time. So a high PE company, investors believe that the future for this company is quite bright. A low PE company, very, very pessimistic about the future for that company. And it also gives you an idea of how long in years it will take the company to earn back its price. Not that that's important, but it's something to think about. If you have a PE of 20, that means in 20 years, assuming nothing changes, and of course it's changing all the time, it'll take them 20 years to earn back their price. PE of 6, takes 6 years, a PE of 10,000. Right, that's how you know that was way too high. And of course, eBay went on to lose 80-90% of its value. It didn't disappear, it's still around, unlike many of the other internet companies that are long gone and in the dustbin of history. Now, slide 31, the dividend yield. Oh boy, do we love dividends, folks. We talked about dividends, right? Dividends are cash in your pocket, folks. They put money in your pocket. Well, they don't send you a check anymore. It's all electronic. But still, it's very cool. Dividends. Companies can pay dividends. They don't have to. They're optional. But they are distributions of the earnings. And the dividend yield is the yearly dollar amount generated by a stock divided by the current market price. In other words, this allows us to compare the stock to a savings account or a bond. And historically, they were in the 4, 5, 6% range for well-established companies. But now 2 to 3% is typical. Many pay nothing because why? They need the money to grow the company. So companies that are growing very rapidly would not pay any dividends. But other companies that have been around for decades, yeah, sure, they're paying great dividends. And some are paying more than 3, 4, 5. We'll take a look. We'll see some examples. Dividends don't lie, dear students. Dividends are cool. Slide 32. Here's an example. If we have $1.50 in dividends coming from this stock, great. How much did we have to pay for those dividends? Well, $87.50. So you take $1.50 divided by $87.50, and it turns out that stock is paying 1.71%. Which is more than what some banks are paying, right? But what's the difference? The bank account is guaranteed by the full faith and credit by the United States government, right? So you're not going to lose money. But what could happen to the price of the stock? It could go to zero. It happens every once in a while with companies, Kodak, GM, when they went bankrupt. But it doesn't often happen. But the price will be volatile, folks. And so next year, the price might be $40 or it might be $120. That's stock investing. But right now, it's paying us 1.7%, which is not bad. Oops. Well, let me be clear about one thing. When I say it doesn't happen often, I'm talking about companies that have been around a long time, that have been paying dividends for a long time. The brand names that you know about, and some you don't know about because they don't necessarily deal with the general public, maybe business to business. But there are other companies, more speculative companies, brand new companies, small companies that go out of business all the time, folks. So we have to go back and, again, determine what's our risk tolerance when you invest in a company like Johnson & Johnson or Home Depot. It's very different than investing in the latest high-tech startup that may or may not become the next Facebook or Twitter. So there are various degrees of stock investing risk and return. And I hope we've made that clear, and we're going to discuss it even more as we go along. But now let us turn our attention to slide 33 and take a look at some examples. Now that we've gone through the different measures, and there are, as we said, many more that we would learn about in Business 123, Introduction to Investments, and then even more than that. I mean, it's a lifelong process. So in the face-to-face class, we would have already gone through all the problems on the worksheet. You can do that now. Stop the presentation, go through the problems in the worksheet, or do it later. But here we're taking a look at two mom-and-pop shops down the corner that sell Walmart and Costco, right? And if you were to look at the prices, you might think that, wait a minute, is Costco worth more than Walmart? Well, now, you know, intuitively that Walmart's bigger than Costco. How much bigger we're going to see in just a few moments. But let's take a look at the earnings per share. $3 for Walmart, $6.83 for Costco. And what are the PE ratios? Well, they're fairly close. But Costco's a little higher. By the way, these are very high PE. Stocks are extremely, I wouldn't say extremely, but they're richly valued now. And so any kind of exogenous, you like that word, exogenous? Any kind of event that's outside our awareness, such as a trade war, could really throw stocks for a loop. But that's part of the stock investing, and you live through the ups and you live through the downs. What are investors saying about the prospects for Walmart and Costco? Well, they're a little bit more excited about Costco, but not much more, just a little 2 points more in PE. And what would we see as a reasonable PE for these? I think 16, 17 is reasonable. So personally, I wouldn't want to invest in Walmart and Costco. But the rest of the world, or we shouldn't say the rest of the world, but investors in general are pretty darn excited about the prospects for Walmart and Costco, and are saying, yeah, we're excited about the future for them. And if it weren't for the trade war, I would tend to agree with them that both companies are well managed and are global in nature and should do well. But I think they're a little overvalued right now. What's the book value? Well, remember we discussed the book value is basically an accounting issue. Take the assets, subtract the debts, and then what's left over is the book value. And notice that it is much less than the price. And that makes a lot of sense, because what investors are saying is Walmart, Costco are worth more intact than if you were to liquidate them, sell off all the assets, and pay off all the debts. And that just makes perfect sense, doesn't it? Because they are going concerns, as the IRS likes to say. What are the dividends? Well, they're very similar. $2.08 per year for Walmart, $2.28 for Costco. But because Walmart is much cheaper on a stock basis, we're actually getting paid 2.5% from Walmart, and we're only getting paid 1.1% for Costco. So Walmart investors are demanding a higher dividend, where Costco investors they're not that. I mean, 1% is what many savings accounts are paying now, so it's not that bad. But what's the big difference, as we said on the previous slide? Right, exactly. Now we finally get to the market capitalization. Remember the formula? You take the number of shares, and there are about 6 billion shares of Walmart, and you multiply times the stock price, and you get, whoa, $255 billion. That's what Walmart is worth. Yeah. If you wanted to buy Walmart, you'd have to trundle on down to the New York Stock Exchange with $255 billion in your back pocket and say, I want to buy Walmart. Now, it doesn't work that way, and nobody's going to buy Walmart because nobody has that much cash. But that's basically what the company is worth. And everyone looks at the stock price, but that's meaningless. The important thing is the market capitalization. And so Walmart is one of those mega cap stocks. There's not that many of them, but there are more than there used to be. Stocks that have market capitalizations above $100 billion. And Costco is no slouch, but it's less than 1/3 the price. Not 1/3, about 1/3 the price. A little bit more than 1/3 of the price of Costco. Got it? It's almost a mega cap, but it's definitely a large cap company. So, is this that hard, folks? I don't think so. You know, as Warren Buffett likes to say, and I've told you, I'll tell you again, investing is simple, but it ain't easy. Because looking at these numbers, we have to decide, are things going to stay as great as they are now? Because if they are, sure, both of these companies are well managed, they're not going to go anywhere, they're paying dividends, but the price is pretty darn high. And history tells us that the market goes up and the market goes down. So as a value investor, and we could discuss value versus growth and all that stuff, many value investors would say, hey, this is far too high. Others would say, no, I'm buying the two excellent companies. And we would have to go out and look at what other companies, right? We'd have to go out and look at a Target, and who else? And then who are the other competitors? I don't know if you can count the J.C. Penney's and the Macy's of the world, because they're jockeying to stay alive, because they're getting hit from the Walmarts and the Costco's and the Targets from below, and then by the specialty retailers above. So let's now take a look at another set of companies, McDonald's and Yum. Yum Brands. Who are they? Who is Yum Brands? Well, you know them as Kentucky Fried Rat, Taco Hell, and Pizza Crap. I'm sorry. Kentucky Fried Chicken, Taco Bell, and Pizza Hut. Yeah, I'm not a big fan of these companies, folks. Why? Not because they're not profitable. They're very profitable. But they're selling people sugar, salt, and fat. And it's expensive sugar, salt, and fat. You think you're getting a good deal. No, you're not. You're not getting a good deal. But there's a whole lot of people who go there every day, the fast food places. Yeah. Anyway, let's now get rid of the ethics and the health and take a look at it, because we want to make some money. And we look at McDonald's and Yum and we think, wow, McDonald's is a lot more expensive. And it turns out that in this case, it's also worth a whole lot more, as we'll see. The earnings per share are $6.61 for McDonald's and $4.27 for Yum. And the PE for McDonald's is 24, whereas the Yum is about 18.5. So right off the bat, we can see which company are investors more excited about? McDonald's, right? They're willing to bid up the price of the company, the stock, relative to the earnings at a higher PE. 18.6 is a little high from a historical standpoint, but not too high. 24 is fairly high. But who are they more excited about? Investors are more excited about McDonald's. Now look at the book value. What's going on here? If you were to try to sell McDonald's or Yum Brands and then pay off all the assets, you wouldn't have enough money pay off all the debts, liquidate the assets and pay off all the debts. You would not have enough money to cover the debts. And why is that? Because these companies are so sure of themselves that they're willing to load themselves up with tremendous amount of debt, because they say, hey, no problem, we can pay it. Because, they have cash flow statements and net worth statements for the companies too, folks. They just got a lot more zeros, a lot more numbers. So no. McDonald's and Yum are not in any way, shape, or form going to be liquidated and sold off for their assets. Look at the dividends per share for McDonald's, 4.04, and Yum $1.44. So McDonald's, even though it has a higher PE, is paying us a higher yield, a more rich yield, 2.5% versus 1.8% for Yum, which are both healthy dividends because these are both large companies that are rooted into people's stomachs. But when we actually take a look at the market capitalization, as you might have expected, McDonald's is much larger, $126 billion in market capitalization versus almost $26 billion from Yum. Now, if you had seen this data about 8-9 years ago, before the Great Recession, or about right before the Great Recession, you would have seen that it was reversed. Yum Brands had the higher PE, even though it was still much smaller in terms of market capitalization than McDonald's. Why? Because Yum was kicking McDonald's butt in China. They were literally just killing it. Because why? Well, Kentucky Fried Chicken was just exploding. It turns out the Chinese like chicken more than they like beef. They're I guess where they're learning to eat hamburgers, but they love chicken a lot better. And so the cool thing to do, the status symbol, was to get in your Buick. No, I'm not kidding you, folks. Buick, because Buick is the Mercedes and BMW are trying to change that, but Buick is the luxury brand in China. GM sells more Buicks in China than they sell in the United States. And drive down to the drive-through, the Kentucky Fried Chicken, even though it took you less time to walk there because of the traffic. And that was the status symbol. And then what happened? Something totally exogenous, I love that word, I've used it already, external to Kentucky Fried Chicken. Bird flu. Bird flu took hold, and people just stopped going to the Kentucky Fried Chicken, even though there's never been a documented case of anybody catching bird flu from a dead cooked chicken. The chicken has to be alive for you to catch bird flu, but that doesn't matter. The Chinese are just as irrational as we are. And so Yum just collapsed. And then they went through they didn't know what to do, so they restructured and they sold off Yum China. And Yum China now is a separate company, and they're trying to rebuild and trying to tell people, you're not going to get bird flu from a dead cooked chicken. You're going to eat it, and you're not going to get bird flu. So figure that one out. Anyway, so that's the thing. That's what stock investing is all like. It had nothing to do with Yum, the company Yum. They were doing just fine, but the bird flu killed them. Or it didn't kill them, but it changed their whole corporate structure, and they've had to readjust. And it seems like they're trundling along. They're not going anywhere until people realize they're being sold a lot of sugar, salt, and fat. Let's continue, Frank. You're blithering. 35. AT&T and Verizon. You ever heard of these two companies? Yeah, the duopoly, as it's called. You think people will ever give up their mobile phones? I don't think so. I mean, it's almost as if you try to get a young person to turn off their phone. It's like you're trying to turn them off, like the computer from 2001. Don't turn me off. So we look at the price of AT&T and Verizon, and we might be tempted to think that Verizon is a lot bigger. Turns out it's not. They're about the same size. But again, we've learned to look at the market capitalization. And earnings per share, $4.96 for AT&T, $7.63 for Verizon, 6.5 PE, 6.5, a little over 6.5 PE for. What's going on? You looked at McDonald's, you looked at Costco and Walmart, and they have these very high PEs. And why are AT&T and Verizon sporting such small PEs? What are investors thinking? Well, investors are really not excited about the future prospects for either of these companies. They figure everybody's already got a cell phone, and so they just have to cannibalize each other. So investors are not, we're not that excited about them, so we're just avoiding them. The book value of both is a lot higher relative to the price than we saw in the other companies. But again, it's still not that much less in the case of AT&T. And dividends per share, $2.36. Look at that yield. 6.1% for AT&T, 4.6% for Verizon. What is going on? These dividend yields are higher than what most companies are paying in interest for their bonds. It's certainly a whole lot higher than what AT&T and Verizon are paying in terms of what they're paying for bonds. It's a little bit of a conundrum. So if you're a very happy dividend dividend receiver, if you love your dividends, which I do, I love dividends. Dividends don't lie. Then you would love AT&T and Verizon, especially, and these are sometimes called value investors, especially with these low PEs, because if things even just don't go very well for AT&T and Verizon, it's hard to believe that they're going to go anywhere. Then there's a whole lot of cushion there. There's not a whole lot for the stock to fall because of that rich dividend yield. And notice the market cap. Both of these companies are mega cap companies. AT&T is worth a little bit more than Verizon, not that much more. So are you seeing that stock investing and analyzing stocks is really fairly simple? Once you take a look at the numbers and you say, okay, I kind of got that. What's the hard part? Trying to predict the future. And so the future, according to the investors, right now, on July 10th of 2018, is saying that, McDonald's and Costco and Walmart, and to some extent Yum, but not as much as the others, are just gangbusters. This is the company you have to own. Who don't worry about the high PE. The future looks bright. Whereas AT&T and Verizon, we don't care. We don't want them. And so you have to decide in 3 years, what's it going to look like? And of course, does anybody know what the future? No, we don't know. If we knew what was going to happen in the future, we wouldn't call it the future. We would call it the past. And it's easy to go back and see and understand what happened 2-3 years from now behind us. But trying to figure out in the future. Now, if you were to put a gun to my head, I would say, you know what? I'd rather own an AT&T and Verizon right now, collect that dividend, because I'm worried about what's going to happen to the markets. I think they're going to have a major downturn. I don't know when, but I've been predicting that for more than a few years because stocks are very richly valued. But looking at the economy, the unemployment rate, the fact that until this trade war started, the rest of the world had said, yes, capitalism might be the worst possible economic system ever devised, except for all the others. So we some too, me some too. We want to get in on this. And you go all around the world, and you can see Walmart, and you can see McDonald's, and you can see Coca-Cola, and Google, and Nike, and Michelin, and Unilever, which are foreign companies, but they're Nestle, but they're basically companies which are countries unto themselves. And so I'm very optimistic about the future, except for what's going on right now with the trade war. And I keep reading as much as I can and from the experts, and many of them keep saying, no, don't worry, cooler heads will prevail. But I don't know. I don't know if that's what they said in World War I. The cooler heads will prevail, and then all of a sudden there's the First World War. So be ye joyful even after you've considered all the facts. Now, in our next presentation, we will delve further into the wonderful world of stocks. So I hope your interest is piqued. I certainly hope, because this is something that is so exciting. And of course, I teach this stuff. That's all. I'm a stockbroker. That's all. But the coolest thing about the investing world is that you will never, ever be wanting for learning more. There's always new companies to research. Always new things that are happening in technology and in old technology too. And so it's a never-ending hobby, and I hope that it brings some of you joy. And for the rest of you, there's always mutual funds, which is our next chapter. See you in our next presentation.